plugged in to the Delphi podcast.
Hey everyone, welcome back to the podcast. I'm your host, Jordan from Delphi Research. I have David, Choi, and Conor Moore here from USD.AI. How are you guys?
Great.
Doing well.
Doing great.
USD.AI is a synthetic dollar backed by AI and DeepEnd hardware assets. We released a report last week on the portal. That's a great primer. It's free right now, so definitely go check that out. Conor and David are here to provide some additional color on the vision for USD.AI and how it impacts infrastructure finance. How about we start with some quick intros and background?
For sure. I guess I'll go over the team real quick and then pass it off to Conor for just kind of our earlier journey. Conor and I, we both met at Deutsche Bank, kind of coming from TradFi. I think it's also the pattern in all of Delphi as well, kind of escaping TradFi. But we worked together on real estate investment banking. I personally moved into like the early MEV scene back in like 2017, 2018, where it was like the earlier attack surfaces before it was even called MEV, like gas bombing for ICOs or like LP sniping for like Uniswap. And did a lot of venture over the years. Yeah, I guess my focus on the team is more on DeFi and redemption design with this like TradFi plus MEV experience. Connor's background is after Deutsche, he also focused on real estate private equity and like structured credit. So all the way from tenant management to like distributed asset management to Fannie Mae style debt aggregation, more focusing on the physical assets, the cash flows modeling, and like the credit structuring for the lending primitives that we're inventing for USD.AI. And we have a third co-founder as well, who's not on call. He's actually kind of like the perfect background for USD.AI in that he used to work at 21.co back in like 2013, 2014, right when like Bitcoin mining was moving away from the GPUs toward the ASICs. And you saw the first-hand industrialization of the crypto mining infra and how like early debt was introduced to mining for the Bitcoin mining specifically. Then he worked at DRW working on FPGAs for HFT, we also did MEV together. So kind of he focused on the smart contract system design and like hardware level risk on the team. And yeah, we all came together in like late 2021 and early 2022, originally to focus on low liquidity assets, but Conor will explain that.
Yeah, I can give some more kind of background on our path. So when we started the company, we were really looking at what was happening in DeFi, particularly Aave, Uniswap, Compound as sort of these 0 to 1 moments in financial innovation where you actually had, tremendous improvement, 10x, 100x improvement in execution, but it was always for, AMMs for swapping liquid tokens, CDPs and lending markets for borrowing against liquid tokens. It was all kind of catered to liquid tokens, and we thought there would be sort of a next wave of financial innovation happening on crypto rails, particularly for illiquid assets. So think capital markets, debt capital markets, equipment financing, financing businesses, the things that we had experience with in our past life in traditional finance. And so we started the company. Originally, it was called MetaStreet, started in 2021. Basically, over the last 3 years, have done about $400 million of loan volume. But we've always struggled to kind of find the right collateral pair for what we're doing. And what you've seen in the RWA space is there's a lot of adverse selection problems where, for example, if someone's tokenizing real estate and trying to get a loan on chain, you typically would ask like, why are they not getting a loan from the most robust debt market in the world, which is like real estate debt? And so, we've really struggled to find like the right collateral pair. And I think in the last kind of 6 to 12 months, what we've realized is DeepEnd networks and specifically the hardware that underpins these networks is a really natural fit for on-chain financing for illiquid assets. And so we started this separate vehicle called Tactical Compute, which is basically an AI mining network in partnership with Aether and Beam. And the whole idea there was to basically raise capital and buy GPUs or get access to GPUs to earn yields from these decentralized AI networks. And in that process, what we realized was even though the cash flows are quite good and we were super well capitalized, it was basically impossible for us to finance that vehicle. because you're earning cash flows on chain. So you're precluded from, what a bank would be able to do or private credit fund, because fundamentally, when you're doing things on chain, you really need an on chain capital source to pair with what your use is. And that was sort of the inception point for USD.AI. The previous few years of doing structured credit products for illiquid assets, paired with kind of this new vertical within DeepEnd specifically for AI, but also for telecom, DeepEnd assets or energy networks, where all of them are really CapEx intensive. And at the same time, you can't actually finance these assets because you're earning cash flows on chain. And so that was basically what led us into wanting to build USD.AI, which fundamentally you can think of USD.AI as it's a yield-bearing synthetic dollar. And the yield is coming from hardware assets that are being collateralized into loans. So GPUs, telecom, energy, these are CapEx intensive asset types. The operators of those assets can basically get a loan from USD.AI and pay interest. And that interest is what goes to paying yield out to the USD.AI token holders. And those USD.AI tokens can then be, proliferated through the rest of DeFi, borrowed against, swapped, etc. And so it's really a crypto native structured credit product for illiquid asset types within kind of these DeepEnd network ecosystems.
So this is DAI meets internet capital markets, and this is real capital, productive capital, not crypto native capital markets. Can you help me establish the market for this a little bit? What DeepEnd sectors, what sectors is this applicable to, and what's the total size that of this market?
So I guess we can start from like all RWAs, like crypto native RWAs, and just really focus on DeepEnd as a sector. And that heuristic is just really finding that greenfield of like, hey, good credit, but like kind of underbanked in a sense. And among that, even you're seeing this behavior among DeepEnd protocols where they're focusing on scale. We call it like a bit of a DeepEnd trilemma, where they either balance out scale, price, or data fidelity, or just like quality of output within the asset itself, whether they're providing compute or they're providing energy. A lot of them are trying to lower the barrier of entry from the incremental user by lowering the price, which naturally sacrifices quality. So the areas that we really focus on are sectors that have expensive hardware, things that are actually valuable. Like there's a good reason why LLMs are not powered by consumer grade hardware. It's run by H100s and things like that, because it's designed to be productive. It's not designed to be cheap. And that kind of heuristic is exactly what that is really good for, because it will make good cash flows in the future, but it will definitely have higher barriers of entry. And so we really underwrite the hardware itself and like what it's actually valuable for. We don't necessarily underwrite the DeepEnd network. That certainly helps in terms of bolstering the cash flows, but we really look at the hardware and hardware quality, because the hardware's mostly semi-fungible in a sense. So once you underwrite one, there are some nuances between maybe one H100 and a data center in Texas versus one in Europe, but generally they're pretty similar. So we probably look at things that are above that 10K per asset range to start off, because it's just the most scalable, and it's also where the most need is in terms of this CapEx story, where it is cash intensive. These protocols or these miners want to grow, they can't get financing, and these DeepEnd networks are just inflating their token all the way down, because they're trying to compensate for that initial growth hurdle of like participants putting up that much money in order to get their money back, which they call the payback period when it comes to the concept of mining.
Interesting. Yeah, one of the coolest parts of USD.AI, I think, is the unique problem set that you guys had when building this. So this hardware doesn't mark to market. There's a lot of unique issues with the game theory and the default process that you have to solve for. So you guys sort of created this Oracle-free DeFi structure from the ground up, and from a product perspective, not from a philosophical need, right? So can we go over like USD.AI structure at a high level and what makes up USD.AI?
Yeah. I can go over the like very high levels and the details we can kind of split up. But there's really three pillars that kind of like establishes that. The Oracle's lending is the base structure, but that's really supported by these three categories that makes it all possible. Because you don't have an Oracle like a single source of truth based on like a very mark to market, which is like how frequently something's marked in the market, right? We have three mechanisms. One, and they can be kind of separated as the entry, the risk scaling, and then the exit as like um, the allegory here. And the first one is we call Caliber, is like it's an acronym for like how we tokenize assets in a way that I think is superior to many other methods because we actually deal with a physical asset, something you can pick up and like put away, and not no SPVs and no like shrouds of uncertainty. Secondly, we have this modular underwriting system, which we can go into in a minute, but that really focuses on how to scale up the various underwriting processes of different hardware globally in the world that actually powers these AI networks and what we give the physical loans to. And lastly, we have the QEV design, which is an acronym for Q extractable value. This is inspired by Flashbost's MEV boost, which kind of mimics this Q that is invented. We kind of view like these uh, liquidity blocks as like block production in a sense, where people are competing in a blind market to exit the redemption. That way, this is a little more game theoretical in how you exit the pool. But yeah, those are the three main pillars which we can go into. But I'll let Connor take the first one.
Yeah, so let me talk a little bit about Caliber because this is a really kind of critical component for this to all work. So what we did here is we basically, in order to execute a loan, the loan is happening on chain. And in order to execute a loan, we have to have an initial legal contract that's basically tokenizing assets. And so what Caliber stands for is collateralized asset ledger with insurance, bailment, evaluation, and redemption. But basically, all we're doing is in order to execute a loan, the borrower has to sell the assets to a subsidiary of Permian Labs, which is our Delaware C Corp, in order to get their loan. And the reason we do that is because this allows us to get a master insurance policy over all of the assets because the assets are actually technically legally owned by us. And then once they've sold the assets to us, they sign a separate contract that's a bailment that basically gives them the rights to operate and profit from the assets. And in that bailment contract, what we do is we say the bailor, who's the rightful owner of this, is actually this holder of this NFT. And so there's no loan agreement that's ever happening off chain. The only off chain component is what we're doing with this tokenization and subsequent bailment contract. But then what this does is it gives us the ability to put property rights completely on chain. So that NFT is called an electronic document of title and it fits under UCC Article 7. And it basically is just a way for people to transact and have an electronically native deed to an asset. So once that exists, then the borrower can post that deed as collateral and borrow from the pool. From there on, every point of property rights exists solely on chain. And the reason this is really important to us is because when you think about the RWA space, it's a bit hand wavy in terms of what tokenization really means. And what I mean by that is you'll see a lot of products that have some underlying loan agreement that then gets rolled up into a fund structure. And then that fund is then selling some portion of its fund into some tokenized entity to then sell on chain. The point is like your property rights do not exist on chain. They exist off chain. And then hopefully these various intermediaries that you're interacting with are going to honor that. And we don't really like that. So what we're doing here instead is putting 100% of the property rights on chain. And then when you think about what's happening ultimately is you're putting this, tokenized yield product out into the world. But we want the users, the buyers of that token, to be able to drill down into every single loan, and you'll be able to see exactly what's happening at all times and see that is completely on chain, and you have complete, actual property rights in that case. The next part to mention, so that's basically sort of this legal construct that's underpinning everything we're doing here, which is called Caliber. The other part to kind of like really dig into is what the actual underwriting process looks like. because USD.AI is going to be supporting, everything from neoclouds and GPUs all the way to telecom assets, power assets, EV chargers. So any of these DeepEnd networks that have sort of this hardware infrastructure component to it. And so obviously it would be, a lie to, basically present ourselves as experts in every one of these possible categories. I was just talking to guys yesterday that are doing weather stations. Like, obviously I'm not an expert in weather stations. So what we're basically doing, and this kind of builds on the original MetaStreet pool structure, is for every primary origination market, there's two tranches. The first tranche is the first loss position, and that's basically 5% of the capital stack. And then there's the second tranche, which is what is actually going into the USD.AI backings. So that first tranche is the first loss, and that the capital that goes into that first loss position is also the underwriter and originator of those loans. So that you have some alignment of interest in that first loss position gets some outsized return in exchange for, originating these deals and underwriting them and putting up that first loss capital. But they also, bear first loss. If there's defaults, they're the first ones that would lose their money. So that position is basically held by, experts in the specific subject matter that we're looking at. So, there's a first loss underwriter for the GPU space, there's first loss for EV chargers, et cetera, et cetera. And then David probably should talk about QEV because that was really his baby.
For sure. And QEV was kind of an analysis that was made from past attempts in terms of a lot of these blue chip RWA protocols that claim to have good collateral, but oftentimes do end up depegging, because even blue chip collateral can become pretty toxic if it's not managed correctly with maturity schedules. And QEV, I guess, in summary, is really an arbitrage venue where participants can actually profit from DPEGs. And that's kind of like the main heuristic in terms of how we designed the entire redemption queue. Oftentimes, redemption queues are first come, first serve, which is whatever available liquidity there is. It's whoever like redeems first, or it's like some whitelist system, which is a little more opaque. For us, it's we turned it into a market in a sense, where every 30, because these assets that we deal with have extremely high amortization, that's more of a feature than it is a bug, because what that means is that the loans amortize as well, at equal or faster speed. We prefer faster, and that means that every single month there is a large cash up from the principal repayments, and as well as the depreciation, which mimics the depreciation of the hardware. So I guess it's best to give an example. If, for example, this loan amortizes about 5% a month, because that's just the way that the loans are structured. The straight line to zero, say after like 24 months, 18 to 24 months. Then what happens is that the liquidity that's cashed up, again, from that loan principal, decreasing every month with increasing cash every month, participants can then enter into an auction that happens every 30 days. Because every loan payment happens every 30 days, what you do is aggregate all these depreciation repayments, and you put it up for an auction. We call these QEV boost auctions, which is effectively every 30 days is a synchronous auction, where you can put in a blind bid that nobody knows what your amount is, whether it's and you can bid like 1 bip, 2 bips, and whoever has the highest bid gets the highest pro rata amount of liquidity into that redemption. So this is, again, a very big arbitrage venue where a participant can buy, say, SUSD.AI, which is our staked version with like a longer redemption queue, like this 30 days specifically, and then enter into this queue, even though they bought it at a cheaper price and they redeemed it at par. And what we're really trying to mimic is just understanding the perspective of effectively an arbitrageur, a stablecoin market maker, or any participant, and buying these assets in the secondary, but making a profit in the primary. And that's why we made the redemption queue into a market where it is a little more game theoretical. The question is, what's the Nash in terms of how much a participant should bid in order to get the most amount of liquidity for their position. Now, if you don't bid at all that bidding amounts in terms of this redemption queue is then just given back to all the participants in the market. So if you do nothing, you just get supplemental yield, profiting off this like traffic tax. And the blind nature of it is what helps amplify and stabilize the entire stability of the synthetic dollar. Yeah, so that's kind of how QEV works at a high level. We have more details, obviously, in your report and in our docs as well.
Nice. So to summarize this, USD.AI is a vehicle for on-chain users to provide liquidity to DeepEnd operators who are essentially looping. And Caliber and the rest of your process puts as much of this on chain as possible. And as we've seen with other sort of real world asset projects, there's a modular underwriting process that allows specialized actors to bring into the USD.AI umbrella various hardware types from various like DeepEnd sectors. And the yield for USD.AI is the interest paid on these loans from the DeepEnd loopers. Is that correct?
Yep.
Yeah, exactly. And we're really trying to fit in. What we're really trying to do is like take a capital markets, or I know we call it ICM nowadays, but capital markets is assets that are actually productive, and configuring it so that it becomes fittable into the money markets that we have. Because you can't take an NFT and put an Aave. You can't take a piece of hardware and put an Aave. So this is kind of this fungifying process, I guess.
Nice. So we spoke a little bit about the game theory and like the default process. Can we double click on that a little bit as far as okay the equity cushion and the amortization process and like how for people who may be concerned about defaults and losses for LPs, like how can we do a quick overview of that process and how we prevent bad actors?
Yeah. So we basically think of everything in lines of defense. So you have, the LTVs on the loans are less than 100%. So you have, 70%, basically 50 to 70% LTVs day one. That means that you have a 30%, 50 to 30% equity cushion. And that equity cushion is really the first loss, right? If a borrower defaults, the first person that's going to lose money is the borrower because they put up that equity cushion. The next line of defense is the first loss position. So the underwriter is going to then take the next portion of loss, and then finally you have sort of the actual exposure of the protocol. And so what happens is every 30 days, let's say the loans are 3 years long. So every 30 days, the loans are going to amortize by about 3%. And so that means that, you basically are using these loans to finance acquisition of new hardware. And so you're buying, day one, you have a 30% cushion. Over the subsequent 3 years, those assets are presumably going to depreciate by some amount. But because your loan is being paid down every month, you're continuing to maintain this cushion. And so even if the borrower ended up defaulting, you should have a profitable default scenario because the loan can basically, the rights to the collateral can basically be sold at a discount to what the fair value is. And so what happens is every 30 days, these borrowers have to make these payments. If they miss a payment, then that deed, that electronic document of title, is basically auctioned on chain. And there are a number of resellers, whether it's for GPUs or other equipment, that basically are part of our network that would come in and buy those assets. And so those folks then have this opportunity where I get to buy this GPU that typically costs $100 for $70, and I can resell it for 95, right? Or whatever those margins end up becoming. And so that's basically the whole flow. So you have sort of multiple lines of defense. And then you also have on the depositor side, this ability to basically exit loan maturity because the borrowers have secondary liquidity, or sorry, the lenders have secondary liquidity for these tokens. And so you have kind of the benefit of what looks like, a publicly traded token, but has access to these high yields where you can still get out, whenever you want based on secondary liquidity and these redemption proceeds.
Got it. Okay. So how about the value proposition for borrowers? Can we touch on that a little bit? That's a source of confusion, I think, for a lot of these types of projects. So how much more profitable is it for a borrower to lever up on the DeepEnd operation than like a vanilla non-levered position?
Yeah, it's
They're going to be
basically
they're going to be paying interest rates that are quite high, right? We're targeting what 15 to 20% interest on this?
Yeah, so it's honestly it's a super easy math equation where you just say as long as your unlevered yield, the yield that you're making without debt, is in excess of your interest payment, that's always going to be accretive, meaning it's always going to increase your overall returns. So if you have a 15% cost of capital and you can get a 70% LTV loan, that basically means you can add about 2.5 turns of leverage to your returns. So if you were making 30 unlevered, you're going to end up making close to 70 or 80 with leverage. And the main benefit is really not only for the borrowers, but also for the DeepEnd networks themselves, because the DeepEnd networks are solving for a cost of capital. And right now, in order to attract, hardware operators to that network, they have to give them these crazy yields. And those yields are inflationary. And as David was talking about, the end result is every single network token just gets punished because you're giving out so much an incentive and your network hasn't really stabilized yet. And so if you can access leverage, let's say that the market clearing rate for these operators is 80%. Well, if you have no leverage, then the DeepEnd network has to pay out 80% APRs in tokens. But if you can access a debt market, then you only have to pay out effectively a 30% APR. So the DeepEnd network ends up reducing its emission rate by over 50% just because you have access to this debt market. The other thing that I think is really interesting as you kind of look not only to DeepEnd related hardware, but just general neoclouds and hardware operators, what we've seen is, there's probably about 200 neoclouds. Neoclouds are just companies that buy GPUs, put them in a data center, and rent them to AI startups. So there's about 200 of those, and all of them have raised somewhere between 5 on the low end to a couple $100 million worth of venture capital money. They're basically raising the most expensive cost of capital to then go and buy depreciating assets. Makes no sense whatsoever. But they don't have access to debt otherwise. The credit market off-chain does not really exist for this space, barring a couple of really large players like CoreWeave. So, in that case, you also have a huge benefit, right? Because you shouldn't be raising venture money to buy depreciating assets. You should be building out your software platform, hiring people, doing high return on cost activities. And so, not even within the DeepEnd space, but also just general GPU as a service platforms are also like huge customers of ours, because ultimately they can access credit. And then for them, it's really just a scale game. The number one neocloud will end up being the biggest by assets. And that's just all it takes for them to win or lose. So if you have access to debt markets, then that means you can buy more assets, which means you can bully out the other guys or acquire them or, do whatever to consolidate power. So, I think there's huge benefits, obviously, to borrowers to have access to debt markets, because it just means that you can be more efficient with your dollars.
Got it. Yeah. Can we touch on the phased approach to scaling USD.AI over the coming months and years?
Yeah. So initially, I guess really the first few days into our launch will be mostly in treasuries just to reduce the cash drag. So whenever somebody deposits or mints USD.AI with USDC or USDT, they're minting treasuries. That's kind of like the base layer. And that's, again, whenever there's still capital, we want participants to at least earn the minimum yield. And then that's being then staked. And that's once it's staked, that's when it's viable for actual infrastructure loans. And our initial target's going to be 40% utilization during this initial period, where we're kind of testing out a few of the parameters in terms of how the protocol works. Our target utilization will likely be 80%. And we don't necessarily have like a peg stability module like any money market would, where it's like like automatically adjusting to a specific target utilization. So again, this is kind of learning in terms of how the market responds. But right now, we will keep it at 40% utilization, unless there's some flexibility and some obvious changes that could be made at the protocol level. But that's probably our like stage 2 when it gets to that maturity state, and once QAV launches with that as well. Now, if there is a governance token, which obviously we're currently structuring, and where the protocol is actually decentralized, that's probably the next step after that, where these parameters can be controlled by decentralized governance. A lot of our protocols already very well decentralized. Technically, anybody can launch the protocol permissionlessly in terms of like different pools. They won't have access to this like large capital vehicle, but they can launch their own like individual borrowing pools permissionlessly. So in terms of the steps after that, we will start decentralizing the income generated as well as the protocol management, which is typical for most projects in this space. As for the underwriting and the modularity in terms of other collateral types that we onboard, that's also going to be a stepwise process as we develop these various sectors. The three main sectors that we're focusing on the beginning is going to be compute, telecom, and energy, where the underwriting scales with obviously more participation and more demand needs. And I think a lot of those use cases kind of emerge once you do have the money as well, or deposited and being utilized.
Got it. So out of the gate, it'll be highly liquid, but the yield will be lower. And then as it becomes increasingly composed of hardware, the yield will increase and it will become less liquid. And that's where the QEV comes in and potentially a governance token. Can you share any thoughts that you guys have had as far as how you would implement a governance token and what that would look like as far as utility and stuff like that?
Yeah. And I just want to highlight the yields that correspond to the stages that I described a minute ago, to your point. It depends really on the staking ratio because USD.AI doesn't generate any yield if you hold it, but you earn points in our points program. We call it cores. So that doesn't make any yield, but you get obviously um, our points program. And then the staked version, if it's like a 50% ratio, then it's just 2x treasuries. At a 40% diversified into like hardware loans, which range from 15 to 30, predominantly in the higher teens. Then the average weighting gets closer to like double digits, like mid teens. And at maturity, it becomes something closer to say like 20%. And that's all contingent again on like multiple variables, and the type of loans that are issued. But generally, all the loans that we do have a hurdle rate of at least 15%, and that's very competitive even in Web2 like our TradFi lending markets. As for the governance token, the goal is that it does earn fees for maintaining the protocol. For example, there'll be like an interest clip all the way to an insurance fund structure as well, which is still kind of being thought out in terms of how that uh, how that yield aggregates. But the more interesting part, besides just fee, profit sharing, is how it kind of participates in terms of the governance of liquidity toward sectors that it wants to help grow. Um, it's a little curve-esque and curve-inspired, but you're kind of gating like in terms of how you underwrite these assets all the way to fee participation and risk tolerance. I think there'll be a point in time where a lot of the best hardware has to be financed by debt. Like, can you imagine a solar panel industry or a data center industry without debt? It's just nearly impossible to envision. And where DeepEnd protocols, if they want to scale rapidly, once they start proving out the initial hardware designs and that it's actually industrializable, much like Bitcoin when it moved away from GPUs toward like ASICs, like even though it was more niche, it was far more productive, even though it's far more expensive. You saw a lot of the growth story being shared with traditional finance, and people really believe in that capex story, and that becomes a really sellable kind of scalable form of credit. And that's kind of what we want to imitate in that same story as Bitcoin, where you saw this massive industrialization of the hardware sector, and that really stabilized the Bitcoin price because now all the miners were now just holding Bitcoin because they had access to credit. So what we hope is that a lot of these different participants, miners all the way from BitTensor all the way to say like Dawn Internet, and other like other emerging platforms, especially in this DAI wave, ranging from you know Prime Intellect to like News and these other ones, which really do depend on like high quality compute. Um, they will not only want access to compute but also credit, which helps scale the wide availability of these resources on chain. So. In terms of how it routes, I think that's a pretty interesting use case. But of course, there's the base level, which is at least the fees that's generated from the origination all the way to the interest sharing.
Yeah, absolutely. The yield component of this is very intriguing. I'm curious how you see yourselves fitting into the broader crypto landscape. Like, do you see this being more of a like intuitively categorized as a DeepEnd project or a DeFi project? I mean, you guys, I believe, are launching on
Yeah.
Arbitrum, so that gives you sort of the yield and the DeFi angle, and then like a lot of the Solana ecosystem is this DeepEnd stuff. So, like, what's your vision for how this fits in to the broader crypto ecosystem?
We do all the dirty work in the in the physical space to try to fit in the DeFi space. And I think generally, I guess the best patterns I've seen in DeFi that, the most recent big success being Athena is really having vertical control over not only the origination, but all the way to the distribution. So origination, structuring, and the distribution itself. You also saw this with Lido, why kind of that was like the market leader by a significant margin. So because you had the P2P validator for the origination and structuring all the way to the distribution of stETH and Rhapsody ETH in terms of the wide ecosystem. And much like how we thought LSTFi was different from DeFi, everything's just DeFi at the end of the day. So we do view ourselves as a DeFi protocol. Now, where we get the source of yield might lean a little more RWAs, might lean a little more DeepEnd, but a lot of the our objective is to distribute the yield that we generate to the broader ecosystem, and we're trying to make the rates a little more competitive. Now, there is a bit of a sacrifice where there's a longer redemption period versus what we're normally used to. But I think the DeFi ecosystem is maturing a little bit. Well, we already saw like the 7-day unlock periods for the vault, so as well as with Athena, and so participants getting a little more comfortable with a little longer durations of redemption. And this is also why we deal with specifically hardware, and we don't do any form of business loans, because a business loan is truly a long-term loan, and you can't really redeem any value like during that period of a significant value. So all the integrations that we have in DeFi, we are trying to be like the best rates on Fendel on the PT side, all the way to making the looping a little more sensible, because there is a hurdle rate for DeFi that will move up and down. But for us, we are pretty close to fixed income because our loans are a little longer term, but at the same time, far more liquid than many other designs. And I guess this is also kind of like the way we view DeFi is that people usually say DeFi money markets in a single phrase. And I think that's kind of a flawed thinking that money markets is the end goal. It's really just the first step into a much broader ecosystem, because money markets traditionally move at it's capital that moves at the speed of money, which means that the yields almost always compress to the risk-free rate generally, because everything gets arbitraged very, very quickly. You see this if you're a DeFi farmer, like everything just gets a single digit super fast. That's because we're giving loans against stuff that we call internet capital markets, but it's not capital. Money focuses on liquidity. It focuses on uh, how much is traded and how much volume, whereas capital does not focus on that at all. Capital focuses on things that are actually productive, businesses all the way to real estate to, say, hardware, equipment, things that are focused on productivity rather than liquidity. And oftentimes they're very, very illiquid. Where the daily trading volume is significantly lower than this total asset like representation, in terms of thousands of times bigger. And that's like a nice ratio to kind of measure, is this really a capital asset or a money market? And I think oftentimes when you look at RWAs, people try, and that's why a lot of people are leaning toward RWAs, because they're looking for this exogenous forms of yield to bring into DeFi, to loop and to do interesting stuff with. But to Connor's point earlier, you're getting a lot of adverse selection when it comes to RWAs to come to crypto. Whereas the best RWAs in crypto that people have really liked is actually when TradFi buys an RWA from crypto rather than the other way around, where crypto's buying an RWA from TradFi, if that makes sense. And the three best RWAs, quote unquote, has been T-bills, which is a great use case, stale capital and like trading platforms, so people just get passive yield. That's just seems fairly obvious. Bitcoin mining, it's almost like $25 to $50 billion is kind of hard to really measure. Like it's a lot of debt that TradFi absolutely loves, and like to the point where even MicroStrategy kind of took this idea of convertible debt and made it, which was really popularized by Bitcoin mining, and people love that capex story. And Athena was really cool too because it was a yield that TradFi has never even heard of, right? This idea of delta neutral perps balancing because of this new trading platform and inefficiency, where perps didn't really exist outside of crypto. And this new category of equipment financing kind of follows the same idea of that Bitcoin mining story, where it's a high capex industry. You're mining BitTensor or you're mining something that's on chain, all the way to being familiar with that capex story. And I think it's something that TradFi would actually want to buy along with crypto natives.
And I think like David and I are both very much like decentralization maxis and believe that decentralized networks scale much better and much more quickly than centralized players do. And so, like when you think about what success looks like here, you have sort of the one of the best use cases of crypto, bar none, is capital formation at rapid speed, right? We've seen this many times over. So you have the ability to have capital formation rapidly with just one click deposit and mint a token, right, on the depositor side. And then you have this modular underwriting. So you have a variety of underwriters and originators that can plug into this network and specialize in what their subject matter expertise is. The outcome here is tremendous scale. I mean, much more scale than anything that we've seen in crypto, except for maybe tokenized T-bills. CoreWeave did a $7 billion loan with Blackstone. To give you a sense, CoreWeave now public, but before they were publicly traded, they did this loan at SOFR plus 11. So basically 15-ish% cost of capital for $7 billion. So the scale in this game is so large. There are very few DeFi protocols that ever get over $7 billion, and that was a single deal. And so, I think what success could look like here is really you have the benefit of rapid capital formation plugging into a monstrous TAM of assets that also can't really get, great financing options. We even like have been talking to some family offices who are really interested in buying GPUs and financing those acquisitions through USD.AI. And the interesting thing is the main thing they care about is the depreciation benefit because they just want to take tax write-offs on these big bulky assets. So it's its own financial product right there, just creating a depreciation product for people to offset, capital gains and income. But yeah, I think like the scale is just really important to highlight because it's so much bigger than what we've seen in DeFi. And so for us to be, getting to billions of dollars of deposits would still be a tiny fraction of what the kind of TAM potential is here.
Yeah, so the big idea here is that similarly to Athena and some of these other major DeFi protocols that have come out over the years, we get this fundamental new source of yield that is less cyclical than a lot of these other sources. And then on the other side of it, you have a much better way to scale capital in the real world with these DeepEnd projects. So it hits both sides. That's really interesting. I'm curious. So what are the immediate next steps for USD.AI? When are you guys launching? I think I heard something about a private beta from the X account. Can you give me a little bit of a picture of the next couple weeks and months and how you guys are scaling up to launch?
Yeah, absolutely. Over the last few months, we've just kind of been building the borrower pipeline. And even though it's been months that these people have been looking for borrow, they're still looking for borrow because a solution just fundamentally does not exist. We're finding use cases that we realize we can be the solution for, that just kind of emerge the more you get your hands dirty in the space, all the way down, even still in the GPU market, which you would assume is pretty efficient, but is so extremely inefficient. Not even for Web3. DeepEnd might be the wedge, but even many Web2 use cases, like major brands, major companies, and very good credit in terms of it's a very greenfield credit. There's adverse selection is not really something to think about because you just get really good performing counterparties that just don't have that systemic access. Is systemically underbanked, and frankly, it's because the industry is so new. It's the concept of using GPUs as, like, I would argue, currently the most important commodity in the world. And like, people hear more about like how NVIDIA chips are distributed around the world than oil, especially given the AI race that happens today. So as probably the most important commodity in the world, it's the demand for it has been extremely high. So the demand side in terms of like the yield generation, like how do we generate yield, that's been building up over time. We're still obviously open to chatting with participants on the borrower side who are looking for higher yield generation through the use of that. Now, as for the the DeFi participants, I'm guessing the majority of your listeners on Delphi, we are currently on ramp in process of launching that private beta. So our contracts have been deployed. Now just finished the audit, but now doing a few more steps in terms of making sure the front end and everything is up to our standard. And that should be launching, if everything goes right, next week. And this program, we have a course program, which is our points program for participants who want to generate this, to access this new form of yield. And we are trying to make it very DeFi friendly. So we do want to have the integration with Pendle, having all the oracles up, all the money markets, especially the modular ones. So yield tokenizations and many of the vaults in participation for people who want to either farm the yield itself or they want to farm the points, or both in a sense. And that timeline, in terms of public launch, will probably be closer to the end of May. Yeah, I guess people can keep their ears out and kind of join our wait list. We have a Telegram group and we have a Twitter, so they can follow us there. But yeah, the launch is very soon, and hopefully they'll see it on the recommended farming list on their favorite yield farming platforms.
Yeah, I can't wait to see how this how CT handles all the new yield opportunities with these DeFi integrations. That's really cool. Connor, David, thank you guys so much for coming on the show. This was great. Very interesting stuff. Thank you guys.
Thanks, Jordan.